Yesterday morning was pretty funny in the Peck household. So we both get up, both Burge and I get up around 6:30, and one of us hangs out with one of the kids, and the other one hangs out with the other kid for a half an hour, and then we get ready for the day, breakfast, lunches, whatnot. And on cue, about 7:05, Bowen, my 7-year-old, decides that he's going to have a complete breakdown. We call it a cry out because I'm not going to cut the crust off his toast. He is an able-bodied and able-minded 7.5-year-old, and he fully knows how to do it. And he decides that today he has forgotten how to do it, and the only way that he can possibly fuel his body is if I cut the crust off his toast. And I say no. I say you can do it. So for about 15 minutes, he just sat there at the kitchen table and cried. As is sometimes how I wish us adults could get our emotions out that cleanly and work through it rather than burying it and having to hire a therapist decades later and to talk about it. But then almost on cue, as soon as he was done, there was this coordination where he said, it's almost as he told Everly that it was her turn to start crying out. And her reason for crying out, we weren't really too sure, but she was like, oh, maybe I'll just have a cry out too. So I just thought it was funny, and we let the cry outs happen. It's all part of managing emotions and feeling emotions, but it just seemed like there was this coordination going on yesterday morning in cry outs. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this week is coordinated breakdown. As my kids had their coordinated cry outs yesterday morning, I noticed that there was this pretty strong correlation for sure. Is it a causation? It's always harder to prove a causation, but there does seem to be a lot of causal effect going on between these two different assets that I want to talk about, and it feels very coordinated, and so I want to look at that. The first asset we're going to look at is the Swiss franc, and way back here in September of 2011, it was just absolutely skyrocketing higher, and that was making Swiss exports very, very, very expensive. Switzerland's number one trading partner are countries that have the currency of the euro. So this was absolutely crushing their exports. And so the Swiss National Bank decided, hey, we're going to peg our currency to the euro. And you see on the chart that as fast as it went up, it went down. In fact, it gapped down. It moved so fast. And then between September 2011 to the beginning of this year, it was just kind of going sideways and falling. And then the Swiss National Bank announced, scared, shocked a lot of people, that in fact they were taking the peg off. They were no longer going to be pegged to the euro. The reason it was a shock because just the week before, the Swiss National Bank very clearly said, we will keep the peg. So if you look over here to this, let me get over here and get this other circle right there. That's where the peg was taken off. So when this happened here, there was another asset, gold, that had a very big reaction. And so as soon as this happened here, though this move up and move down looks slightly different than this move up and move down, it is still a very violent move, especially in the currency markets. It was very interesting for me to see and watch and wait to see what would happen with gold. So the next price chart is gold. And if you see here back in 2011, that is where gold peaked. Gold actually peaked when the Swiss franc got pegged to the euro. And since then, it had been falling until really the last, call it from October of 2014 to the end of January. And it stopped going up. Gold stopped going up with the unpegging of the currency. So clearly, this was not a good thing for gold because it happened to it in the past, and now here it is again. Some sort of manipulation with the Swiss franc is happening, and it happened again. And since that unpegging of the Swiss franc, gold's been falling. And I believe that the next major support, now yes, gold has to fall through this 1140 mark here, but the next major support for gold is right around the $1,000 mark. And from a percentage point of view, we're actually not that far off. Yes, it's about 18%, But in a world where something fell from $1,919 and now it's down to about $1,190, that's not too much of a further fall. So it's very likely that gold will move down, move past that 1140 mark, which was the low in 2014, and its next major support is $1,000. So the question is, if you have not liquidated your gold or your silver or your mining, how do you mitigate this loss? If you're one of those, and there's no judgment here, that can't sell their gold for whatever emotional reason, then the next question has to be, how can you hedge it? And the way you can hedge it is by buying it in another currency. Gold is falling very badly against the US dollar, but it's actually doing incredibly well against the Australian dollar, the Canadian dollar, the European euro. I know it's not called that, it's just called the euro, the Japanese yen. So one easy way is to buy it in another currency, specifically buy it in the Japanese yen. This red circle, which is also September 2011, that's where the Swiss franc got pegged to the euro, and that's where gold peaked at $1,919. And since then, the yen has been falling, but this exchange traded fund, YCS, goes up when the yen goes down. And so the way you can hedge your gold position is by buying it in another currency. The way you kind of quote unquote buy it in another currency is to go get the inverse investment structure of that currency. In this case, an inverse yen ETF is YCS. And this way you can hold on to your gold position, and if it continues to fall, you have something that is balancing it out on the other side. So if you had, say, $10,000, $5,000 would be in gold and $5,000 would be in YCS, and this would mitigate the entire fall. In fact, it would more than mitigate, because YCS is up much more than gold has fallen over this 41-month period. So this is a way for you to hedge your gold, silver, precious metals. This is a way for you to hedge that position. As far as the main takeaway, it's really the trend sets the price. Nothing. I mean, there's a lot that goes into the trend, but one of the many reasons why I love price charts and the patterns in price charts is because it takes all the data that's out there in the world and it puts it right into one price chart. And the trend sets the price for the US dollar, which is breaking out and out into the upside. We talked about that last week. It's the same thing for the euro. The euro is breaking down. It's the same thing for gold and oil. And actually, it's the same for everything, whether it's the price of cotton balls or oil or gold or US dollar or the euro or the US stock market or the European stock market. The trend sets the price. And if you understand what that is and where money is flowing, you understand everything. And right now, the US dollar is so strong, and it is continuing to get stronger. It is a huge, powerful freight train that you do not want to get in front of. It will not go up forever. The euro will not go down forever. Gold will not go down forever. Oil may be finding a bottom. So hold tight, because we have a lot of volatility in the currencies, and that's affecting a lot of the commodities, especially with how strong and powerful the dollar has been over this time period. That's the big takeaway. Always look at the price trend. That tells you everything you need to know. Hey, this is just another step in helping you secure your portfolio and secure your future. Until next time, this is RC Peck.